Welcome to Chapter 2 Introduction, and today we're going to talk about a review of the accounting process. Okay, so in this, one of the things that's important to realize is that in accounting we only record economic events, and sometimes it's hard for students to get a concept of first of when an event occurs and when an event doesn't occur. For example, let's say that a salesman goes out to a client and they secure a contract. The client signs on the dotted line and the salesman goes back to the home office. Now they have a contract, and that's very important, and it may even be legally enforceable, but an economic event has not occurred because we are not entitled to anything until we deliver what we promise to deliver, whether it's a service or a good or a combination of goods and services, that sort of thing. So it's important to understand when an economic event occurs and when it doesn't. One of the classic ones you may have heard of, a line of credit. A business goes down to the bank. Businesses often have periods during the year when things are slow and money is tight, and then they have other periods during the year when things are good and money is flush. And lots of times they will contract with a banker to issue what's called a line of credit. Essentially, it's like a credit card. I can call on this line of credit when I need a little extra cash, and then I pay it off when times are good. Well, going down and signing the contract on a line of credit is not an economic event. It's only an economic event when I start to draw on that line of credit. These are important things to distinguish. And so we only record economic events. The other thing, which we talked about and should have gotten in your 2301 class, is that there are three broad categories of accounts when we talk about accounting. There are assets, there are liabilities, and there is owner's equity. Now, owner's equity is one of the more important ones, but it can go by different names at times. If we are a partnership, they may call it partner's equity. If it's a sole proprietorship, we'll call it owner's equity. And if it's a corporation, we will often call it shareholders' equity. And if we're just an individual out on the street, we probably call that net worth. All four of those titles, partner's equity, owner's equity, shareholders' equity, and net worth, all mean the same things, right? So all those things are the same. So let's talk a little bit about each of the other two. Well, we'll talk about all three. First of all, an asset. The definition of an asset is something that I have an ownership right to, right? Now, it's not necessarily something I own. I may lease it, and I still have a right to it. I get the right to use it. I have fewer rights than if I own it outright, but I still have rights to use it. And so, an asset is something I have ownership rights to that I will use to generate revenue in the future. Now, that's important that we use in the future, right? Because when we get to owner's equity, one of the definitions of an expense is an asset that has expired. I used it up. That now it was an asset, now it becomes an expense. Okay, the second category is a liability. That is something that I owe to other people. Now, a liability does not always have to be satisfied in cash, right? Now, if we go to borrow money from the bank wants us to satisfy our liability in cash. But we could have a client come prepay us for a special made product that we're really good at. And instead of satisfying it by giving them their money back, we satisfy the liability by producing the good that we owe them. They're happy, we're happy, and that's how business is done. So an asset is something we have an ownership right to. A liability is something we owe to someone else. And then by definition, whatever is left is the owner's equity or shareholders or our stockholders' equity. Now, in that, on these accounts, all asset accounts are what we call permanent accounts. Okay. All Liabilities are permanent accounts. Now, by permanent, it doesn't mean they're on the books forever. It simply means that we don't close them out and start fresh at the beginning of a new accounting cycle. So at the end of the year, usually. Would it be nice if we could refresh our liabilities at the end of the year? Oh, I borrowed money from you, but now I don't owe you. Of course, if that went on very long, people wouldn't loan you any money, right? And so that's important to realize. But on the owner's equity side, the accounts can be permanent or they can be temporary, or sometimes called temporal accounts. Now, the temporal accounts are generally such things as revenues, expenses, gains, losses. Okay? Also, dividends are a temporary account. The permanent accounts on the owner's equity side tend to be stock, paid in capital in addition to par, retained earnings. Treasury stock is a permanent account. And so we have both temporary and permanent accounts in the owner's equity grouping. Now, it's interesting to realize, and if you get this concept, a lot of things will get a lot easier for you. If you get this concept, all temporary accounts, except dividends, all temporary accounts are income statement accounts. All temporary accounts except dividends are income statement accounts. So it's going to be a revenue, it's going to be an expense, it's going to be a gain, or it's going to be a loss. Those are all temporary accounts. Now you have to be careful. There are such accounts that I call masquerading accounts. They say they're one thing, but they're not. Unearned revenue, for example. By definition, if it's unearned revenue, I haven't earned it yet. So somebody has paid us in advance for something. And if we get an unearned revenue, that's a liability. We owe something. So even though it says it's a revenue, we owe to someone else, and that's a permanent account. Prepaid expense. It says it's an expense. However, right, it's an asset because we haven't used it yet. It's been prepaid. We're not going to use it up yet. An expense is something we've used. And so, so these owner equity accounts, or all these accounts, you have to know what they are. If there's one of the things to learn accounting is to not try to memorize transactions. You do need to memorize certain concepts. And one of the concepts you need to memorize is the accounting equation. Assets equals liabilities plus owner's equity, right? So let's take an example of I want to go start a lawn care business. I did this back when I was a teenager. And I said, I'm going to start a lawn care business. And my dad says, well, you're not using my lawnmower, right? I go, okay. So I go out and I've got $100 in the bank. And so I'm going to start my business. I take out the $100. So I have $100. That's an asset, right? I'm going to use it to make revenue in the future. I don't owe anybody any money, but I have owner's equity of $100, right? Okay, so then I go and I buy a lawnmower. Let's say it costs me $60 to get a used lawnmower. I now have $40 in cash and $60 in lawnmower, and I still have $100 in owner's equity, right? So in that case, the assets changed form, but nothing happened to the owner's equity. Okay, well then I go out and buy a gas can, some gasoline, and Mr. Smith says, mow my lawn, and I'll for 2 months while I'm on vacation, mow it every week, and I'll pay you when I get back. Well, I have to go buy gasoline and that sort of thing, and so maybe I go borrow $20 from Dad, and he goes, I'm getting this back, right? So now I've got $100 in assets, lawnmower, maybe a touch of cash, a gas can, that sort of thing. I've got the owner's equity, but now dad gives me $20 to go buy some more gas, right? So now I've got owner's equity of 100, but I've got assets of 120. I've added $20 cash to that. Okay, so now I use up that $20 in gas. That is now an expense, right? So now I still have the liability to dad of $20, and I have an expense of $20. So I only have assets of 100. My owner's equity is now dropped to 20. Except now when Mr. Smith comes back, I bill him $80, and I'm able to make 80 minus the 20 for the gas is $60 in net income. And my owner's equity goes up, my assets go up, and we go on. So you need to memorize the accounting equation. Assets equals liabilities plus owner's equity. You need to do that. Now, a lot of books will use what's called an expanded owner accounting equation. And that one is assets equals liabilities plus owner's equity plus revenues minus expenses. Okay. Those revenues and expenses are the income accounts, but they are part of the owner's equity. And so that's one thing that you need to memorize on that. The next thing that we have in this chapter is the accounting cycle. Your book uses a 10-step accounting cycle. I've seen it between 8 and 10. Your book uses a 10-step accounting cycle. So the first thing that happens is we gather information about the economic events. And we talked a little bit about what is an economic event and what isn't an economic event. So we gather information about economic events that have occurred. The second thing that happens is we analyze the transaction. Now, in the real world, in real time, as you start to understand accounting better and better, that analyze the transaction just kind of becomes natural. Oh, I shipped the client 30 blue widgets. So I'm going to have revenue for 30 blue widgets, and then I'm going to have cost of goods sold for 30 blue widgets, right? And so that analysis becomes almost second nature as you get better and better at accounting, and yet to the point where you almost forget about it. But it is a step in the accounting cycle. It's the second step that we do in the accounting cycle. Then the third step is we post the economic events to a journal. A journal is nothing more than a chronological log of what the economic events of a company. So you can go through the journal and it will be day by day in order when we do it. Of course, in the modern world, we do that on computers now. But we will post to a journal, and you need to know what's going on inside the computer. That's why we still teach it this way. But that's the journal. And so it's a chronological order of all the economic events that go on. And then from the journal, we will post it to the general ledger accounts. So the general ledger is by category. It's still chronological, but it's by category. So I have a certain amount of sales, for example, so I'll list all the sales in order. And then I will have how many purchases did I make for inventory? That will go in order. Then I'll have cost of goods sold. That'll all go in order. So each category, so each account basically, will have its own ledger page, and I post to that account. So, and one of the important things to realize is when we're making our journal entries is there is always at least two things going on in accounting. If I borrow money, I have a liability, but I also get the asset, right? Two things occurred there. If I perform a service for somebody, right, I will have a revenue for the service, but I have an asset. Either they paid me cash or I have an accounts receivable for that. And so two things happen. If I sell a good, however, four things happen, right? I have the revenue and the offsetting either cash or accounts receivable, but I also have an increase in cost of goods sold and a decrease in inventory, right? So if I have, so always two things, possibly four things. They do not have to go in pairs. For example, let's say I buy a piece of equipment and I put down a 20% down payment, and the company I buy it from finances the remaining 80%. So the piece of equipment cost me $1,000, right? So my assets are going to go up by 1,000, but then I pay a 20% deposit, so my assets go down by $200 in cash, and my liabilities go up by $800 that I owe somebody. So in that case, three things happened, right? And so, but always at least two things have to occur when I record something in the journal. It may be three, four, but always at least two. And that's important to understand. Then the next thing that we do, the fifth thing, is we prepare an unadjusted trial balance. As you remember from your introductory course, we use debits and credits. Debit just means left, credit just means right. That's the only thing that it actually means in our world. And so now, and the trick on this is you have to understand if we're looking at the accounting equation, assets equals liabilities plus owner's equity. If we are on the left side of the equal sign, the assets, then things increase with a debit. If we are on the right side of the equal sign, liabilities or owner's equity, things increase with a credit, right? So with an asset, I increase with a debit, I decrease with a credit. A liability, I increase with a credit, I decrease with a debit. Right. So, but we always must have our debits and our credits be equal. That is a rule. That's a tautology. By definition, it is true. Debits and credits must equal. And this is why we prepare a trial balance. We take the accounts out of the general ledger, the general ledger. That's right. We take the balance and the accounts out of the general ledger, and then we add those all up. Debits on one side, credits on the other. And if the debits and the credits must be equal, that's a rule. And if they are not equal, it means something is wrong. Unfortunately, if they are equal, it doesn't mean we've got it all right. We could have it on the right side, a credit on the right side, but in the wrong account. So our accounts could be off, but our trial balance still balances. But it's guaranteed that if our trial balance does not balance, something is wrong. And so we need to take care of that. Find that error and correct it. Okay, then we record adjusting entries. Adjusting entries are things that would just be called like a catch-up entry. Every time I put paper in the copier, I don't record a transaction, right? I go to the office supply store, I buy a case of paper, and then at the end of the accounting period, I look and see how much paper I have left. And so that will the amount of paper left will be a supplies inventory. That's an asset. And the amount of paper I use will be a supplies expense. And so I'll make those adjusting entries. So I buy the paper and I generally put it all into inventory. And so when I count the inventory at the end of the year, you used half a case of paper. You used 3/4 of a case of paper. I will record that as an expense and write down my inventory on the supplies in order to do that. Those are adjusting entries. And we have to do those for a number of things. We have to catch up how much do we owe our workers. Those would be salaries, accruals. How much do we owe other people? How much has been paid off? Those sorts of things. And those are our adjusting entries. After we make all of our adjusting entries, we do another trial balance. That's the adjusted trial balance. Again, it has to balance. If things balance, then we move on and we prepare the financial statements. We always start with the income statement in preparing financial statements. Then we move to the balance sheet. And then after the balance sheet, we can do the cash flow statement and the statement of owner's equity, the changes in owner's equity. So, but we always start with the income statement. We will then close those income statement accounts, revenues, expenses, gains, and losses. We will close those accounts to the to retained earnings. Now, there's a couple of different ways you can close accounts. Your book just closes it directly to retained earnings. And so if I have a revenue, I will debit the revenue account, that zeroes it out, and credit retained earnings, that boosts my retained earnings. And then on my expenses, I will credit retained earnings, that reduces the retained earnings, and I will debit the expenses, and that zeroes them out. So my expenses in my revenue accounts and also gains and losses accounts will reset to zero at the beginning of the period. So I close those out. And then I prepare a post-closing trial balance. Now, this will be a lot smaller because I don't have the temporary accounts anymore. I don't have the expense accounts. I don't have the revenue accounts to deal with anymore. And so that is the 10-step process, and you'll need to know that in Chapter 2 in order to do the exam and to work your homework on that. All right, so that's Chapter 2 in a nutshell. Again, don't try to memorize transactions, but do try to memorize concepts. So you'll need to know the accounting equation. You need to know that all debits and credits when we make entries must equal, and you need to know the classification. What's an asset? What's a liability? And what's an owner's equity account? If you know those, you'll be good for Chapter 2.